GDP data has come in today for the third quarter at 5.4%, a little lower than estimates and of course lower than quarter two at 8.5%. Let's just take you quickly through the broad top line numbers that have come in today and what the reasons for that could be, because remember, this is for October, November, December, which had not yet seen the full force of the Omicron impact. It had just begun to bubble up in December, in fact. So for Q3, we've seen GDP coming in at 5.4%, while the GVA is at 4.7%. Let's just get you an annual trend, because that's the other big data point that has been released today, where the estimate for FY22 is now at 8.9% versus 9.2% earlier. Now, what could be the reasons for this is what we're also going to discuss on the show. So, as we mentioned, was COVID-19 third wave a factor? That's probably unlikely because the full force of Omicron actually hit in January, but the beginnings were beginning to be, we could see the beginnings from mid-December or so. So perhaps not so much COVID-19. The other big question to ask today is what happens next, because after COVID, geopolitical tensions could threaten growth. And that really, leaves us asking whether inflation is going to be the mood spoiler right now. Inflation has always been a trouble point for the last few quarters. Geopolitical tensions right now really add to the mix. Inflation spikes remain a key concern area, and that's largely because of crude. Crude, even if it settles at below $100 per barrel, is going to continue to hurt India in the days to come. So we will have a conversation about what we could foresee in the next few quarters. But before that, let me go across to Maithili Busramat, consulting editor at ET Now, for her take on the numbers today.
So this evening, the NSO, the National Statistical Organization, released two sets of macroeconomic data, both of which are not very good news as far as the government is concerned. The first is the second revised estimate for FY 2021. The annual growth has been revised down from 9.2 in the first advanced estimates in January this year to 8.9%, as against the RBI's much more optimistic 9.5%. So that's the first bit of not very happy news. The second bit of not very happy news is that Q3 growth, that is the growth from September to December 2021, came in much lower than estimates at just 5.4%. Most estimates were in the range of 6 to 6.5. In fact, the RBI's own estimate was 6.6%. So here again, the RBI has erred by being grossly over optimistic. I hope they don't make the same error as far as their CPI inflation numbers are concerned, or being over optimistic. But let's stick to GDP for the moment, because that's what we're discussing. So you look at the granular details of GDP. What is particularly worrisome is that agriculture, after growing a stellar growth of 4.5% in Q1 and Q2, grew by only 2.6%. Given that we have almost 60% of the labor force engaged in agriculture, and 60% almost deriving the bulk of their income from agriculture or farm-related activities, this is not good news at all. The second piece of bad news really, is that manufacturing has grown by just 0.2%. Now, this is possibly explained by the changes in the base of the previous year. But that alone is not sufficient justification for manufacturing growing so slowly, because remember, the jobs come in manufacturing. The third bit of really bad news, not so good news, I have to call it bad news, is that construction actually contracted by 2.8% as compared to a growth of 6.6%. Now, given that construction is where you employ the unskilled labor, those are the bottom of the pyramid, and given that government had said it would be spending, this comes as a bit of a shock. So all these put together are not good news at all for the government.
So joining me now are Aditi Nayar from ICRA, Kaushik Das with us on the show today, as is Radhika Rao. Welcome to all of you, and thank you so much for speaking with us on the India development debate. Aditi, let me begin with your take. I've told our viewers the headline numbers, but take us through the internals.
Thanks, Tamanna. See, the headline GDP growth number is certainly lower than what we had penciled in. Our expectation was 6.2% for the GDP and 6% for the GVA. So I have to say that today's number is a disappointment. And the two subsectors which have deviated the most from our expectation are manufacturing, where there's virtually a flat YOY performance, and a surprising contraction in construction. Other than that, most of the other sectors have pretty much performed in line with the expectation. But on manufacturing and construction, the takeaway that we have at this point is that commodity prices did bite into margins despite the price hikes that were undertaken in that quarter. And as you said, this is clearly a warning sign for Q4. With the downward revision in the Q1 and Q2 data, the second advanced estimate for FY22 is what we were earlier expecting, which is 8.9%. But the implicit Q4 assumption just seems to be far too high now, given the fact that we've had the impact of the third wave in January on contact intensive services, and margins are under a fresh pressure now, because of the elevated commodity prices given the geopolitical situation. So I would say that Q4 does look like it's going to be barely around a 4% GDP growth. So possibly we're going to end up this year at 8.5% or thereabouts.
That's the thing about how difficult it is to forecast economic conditions right now, because they're being moved by factors which are so unpredictable. So if 3-4 months ago we were all talking about COVID and the next wave and when the wave is ending, now we're talking about the geopolitical situation. Let me bring in Kaushik Das over here. If in Q3 high commodity prices were pinching and hurting quite badly, we had shortages from everything from semiconductors to freight, etc. Do you see this factor getting worse, Kaushik?
Tamanna, first of all, things are very fluid at this moment. We don't know whether oil prices settle at this level, or it goes further up, or it kind of comes down if there is a de-escalation in the tension that we are having at this stage. But just to look at numbers, in October, when RBI gave an estimate of what they are assuming for oil prices to be in second half FY22, they assumed 75 as the average. And they did all their forecasting based on that. So compared to that, now oil prices are almost more than 35% higher. So obviously, this is a big risk for growth as well as inflation. We should not forget inflation. The thing is that if we have state elections ending in the first week of March, and after that, there would be adjustments to fuel prices. We don't know what will be the split, how much the government cuts excise duties to kind of take the burden off from consumers, but whether they can kind of adjust the burden completely by cutting excise duties, or some part of it has to be passed on to consumers, will depend on where oil prices settle by the first week of March or thereafter. So there could be some incremental pressure on inflation going forward, even if excise duties are cut. And that obviously then leads to pressure on household balance sheet, and that could lead to private consumption expenditure coming down. And as you pointed out, the Omicron wave was seen mostly in January. I don't think October-December number that you've got of 5.4% growth that captures the Omicron-related impact. So you'll see the Omicron impact more in January, March. So what Aditi was saying, growth could be, obviously on the lower side. And when we are just getting out of Omicron and we are feeling good about it, then we have this, global tension, which could be negative for growth. And also the fact that inflation could be higher. We already have an inflation estimate of 5.2% for FY23, which is higher than RBI's 4.5%. So we'll have to see whether inflation, continues to be on the higher side in FY23. If oil settles at maybe not above 100, but even if it settles at 90, that is still damaging for the macro outlook. So there are a lot of uncertainties going forward, and it's going to become difficult, for any central bank to decide what to do next.
Absolutely. I mean, it's so quickly that the last meeting, the last set of forecasts become redundant in the current scenario where everything changes. And, Kaushik, I think many people are feeling this, that we just can't seem to be catching a break economy-wise. You have wave 1, wave 2, then wave 3, and now this situation in Ukraine and Russia. But Radhika Rao, I want to come to you on, your take on what you think is behind the kind of numbers we saw for Q3, and will some of those reasons sustain going forward? Some will, of course, worsen. We're going to see the hit on demand because of COVID-19 third wave in January, but factors like commodity prices, inflation, or a subdued demand overall.
Certainly, Tamanna, I think I broadly agree with what Aditi and Kaushik had mentioned. for each quarter, we find a different set of drivers, right? So in the December 21 quarter, we did expect a more broad-based recovery because the COVID problems were, away. The case count was low, vaccination rates were picking up very sharply. There was festive tailwinds. There were a lot of positives in the picture. But there were also idiosyncratic supply pressures, right? Like commodity prices. So that was putting pressure on margins. And also shortages for certain crucial products, which was affecting, the auto sector in particular. Fast forward to the March 22 quarter, again, you find a completely different set of drivers. Base effects are also turning very adverse. So you are going to see, I think, even before this GDP number, we had expected a sub 4% growth forecast that perhaps needs to be relooked, given that the overall trend is coming down. Then you have Omicron fading after a month, but then you have supply side shortages coming up. So certainly drivers changing every quarter. And I think overall we need to remember that what you've also seen in the international space is that after that initial burst in activity after pandemic, right? Waves come in, waves go, then there is a burst, but that fades after every subsequent wave. And I think that's what we are experiencing at this stage as well. So a strong growth finish for fiscal 22 on a year-on-year basis. If you see the revised numbers is minus 6.6, so we'll be at perhaps 8.3%. But I think reality will bite in fiscal 23 because we will still have the headwind of high oil prices, and that post-pandemic drift will kind of fade away. And that's why I think the budget focused a lot on capex and hoping that domestic drivers will kind of mask the weakness in external drivers for that matter. So that's what we are counting on. But at present, it looks like the private sector activity is not something to brag about.
Aditi, let me talk about the inflation question. And now we need to look at it in the light of high crude prices and to what extent they will be passed on. Some estimates are that there's 8 to 10 rupees per litre sitting out there right now, which hasn't been passed on yet. Do you think that that's going to be the scary part once it really hits? And that, of course, will be a bigger decision post 10th March, possibly a political decision on how much of it has to be passed on. And that's the big factor to watch.
Tamanna, I want to pick up on something Kaushik said. I also don't agree with you that the third wave is part of the reason for the Q3 number being below our expectation, because in December, when Omicron had first caught on, commodity prices have actually gone down, and that is supportive of margins. It's only in January when what happened domestically was that a wave started and a restriction started. But at the same time, globally, because the fear related to Omicron had receded, commodity prices have also started going up. So it was a double whammy as far as our situation as January was concerned. But December, we got the tailwind of at least commodity prices having taken a step back because of the fear related to Omicron. Now, going into our crude oil and retail, pump price situation. It's a little difficult to pinpoint exactly how much petrol and diesel prices need to be revised up to catch up to the current crude oil level. We think it's possibly around 6 to 8 rupees per litre for diesel and petrol because, one set of calculations we've done suggests that there was a higher than expected revision that had happened up to November. And therefore, the lag from December onwards is not as much as it would have otherwise been. So 6 to 8 is our sort of, rough calculation in terms of how much, the pain is going to be there. But this is also very similar to the amount of excise duty cess above the pre-pandemic level. So in a sense, the pain to the CPI inflation can at least be taken care of if we have a complete rollback in the cess on petrol and diesel back to the pre-pandemic level. Because petrol and diesel is really what enters the CPI. The cost, of course, is large. It's about 92,000 crore for the government of India to forego, although part of it may well be made up by slightly conservative tax estimation for direct taxes in particular. On the WPI side, of course, the situation is totally different because it's commodity prices, it's crude that come in. So the upside there really cannot be taken care of with an excise duty cut. But at least on the CPI, if the government is to choose to, forego as much as 90,000 crore, then the CPI impact can be largely offset.
Sure. The question now is, what is going to be the impact of what we're seeing in this Ukraine-Russia crisis? Kaushik Das, do you think it's pretty much restricted to the crude fallout, which we will have to, sort of cushion the blow with a cut in excise duties, etc., that can be done on the policy front? But is that the long and short of it, or are we also now having to brace ourselves for a big spike in commodity prices?
So there are a couple of things. Obviously, the trade linkages are not that severe with the affected countries. So to that extent, India will not have a direct impact. But the bigger impact is obviously from oil prices and where oil prices settle, and not just oil prices. You should remember that gas prices are also pretty sensitive to what is happening globally. So if global gas prices go up, then the subsidies that the government has estimated for fertilizers for FY23, they have taken a lower number compared to FY22. Those also go up. So, and then, in March, the US Fed is supposed to hike interest rates, and there are, back-to-back rate hikes that are priced in by the market because US is, seeing a lot higher inflation than their target. So what kind of, global financial conditions we have, and whether there is a spillover from those tightening of global financial conditions into India. You have a problem related to dollar liquidity drying up, given the sanctions that have been announced. So all this will collectively, kind of determine how, this whole situation plays out for India. What is the risk on rupee? If you have oil at 100 and, if you have capital flows kind of, reducing as the Fed starts hiking interest rates, then what happens to rupee, the balance of payments? So there are, different angles from which there could be problems. So it's not just oil prices. The main risk is oil price, but it can have different sources which are interrelated, and that can affect both the fiscal as well as the current account deficit, and obviously inflation. So and obviously the first thing that we discussed, all these things will have impact on growth as well.
Yep, we're seeing that impact possibly coming in the later quarters. But Radhika Rao, we've spoken a lot about situations which are out of our control, whether it's crude prices, it's geopolitical conflicts, and then how the Fed will respond after all of this, in reaction to all of this. What are the kind of domestic factors that we need to look out for, and what can be done to prop up and speed up growth in view of all of these situations?
Certainly, I think external risks aside, I'll just take a couple of seconds on the inflation argument. For the central bank, they could see the commodity price increase, particularly because of geopolitics, as something that's an external risk, and they could also make a case that hiking rates will not necessarily address the problem, and put the onus on the government to come in and provide some administrative support by way of either administrative support by way of excise duty cuts. If there's edible oil, even sector wise, because of what's happening geopolitically, certain oil variants, edible oil variants, are also going to get prices are rising besides palm oil as well. So that will also have inflationary impact. Again, nothing that the central bank's hike can do. So they make a case that administratively the government will have to step in and provide support. So from that perspective, I think they could keep that aside and focus completely on generalized price pressures, meaning is there enough demand in the economy, in growth, to make a case to tighten policy, right? So coming back to your question about the growth front, I think right now the drivers are predominantly going to be how do we do better on domestic demand, and how do we get the investment cycle going. On this front, I think domestic demand and indications are a bit subdued at this point. If you see the rural income growth, that's been quite weak, and if you take the inflation into picture, that means the terms of trade are not in the favor of rural incomes. And if you see even the urban income, some of the indicators, some of the proxy indicators, that has also been soft in the March quarter. And fiscal 23 also, that's likely to continue. So we need domestic demand to pick up, because that is in a way intertwined with the investment growth as well. On the supply side for investment growth, a lot of catalysts are there. You've got the asset monetization program, you've got the infra pipeline, you have the IBC, and of course the PLI scheme that has been introduced as well. So on the supply end, I think there is enough and more for investment to pick up, apart from the fact that the companies are broadly deleveraged as well. But I think to complete that cycle and boost demand, you would need to boost investment, you would need demand to also pick up, and urban, and then of course accompanied by rural as well. So these are the two main drivers I think that the government and the authorities will be counting on for fiscal 23, because exports for us is doing well now, but I think second half of the year, of the fiscal year, we're not very confident that that's going to continue, because if you see globally, China's growth is slowing, and many of the goods that were being consumed during the pandemic, that is now shifting more towards services. So I think that export boom will be hard to maintain. So I would think, yes, like you rightly mentioned, domestic catalyst will be very important to sustain fiscal 23 growth.
Absolutely. So it is a wait and watch situation. Definitely not a great time for economists or anyone who's trying to forecast what happens next. That's a tough situation in all circumstances, especially with geopolitical factors being very, unpredictable right now. And we're not even talking about a possible fourth wave. Let's hope that doesn't happen. But on that note, I want to thank all of you for joining us on the show this evening.
Thank you.